While bank rates are going up in Canada, so what does that mean for you? We all are immensely affected by inflation, so naturally it is a major concern for Bank of Canada as well. This video will help you understand how jump in interest rate affects economy and your personal finances. Don't you think we all should be well informed about implications of rate hike where our central bank is ramping up benchmark rate in an effort to control inflation? Hence, let me put forward my perspective about implications of rate hike in Canada. Hi, my name is Sunny and I make content that affect a common man financially. If you're new to this channel, please subscribe to it alongside smashing that like button as that will help me with the YouTube algorithm, which of course will be highly appreciated. The Bank of Canada has raised its benchmark rate by 0.75% very recently. They are of the view economy is operating close to its potential while inflation is expected to return to target within the next 2 years. Therefore, further gradual rate increases are likely to be required over time to control inflation. This recent rate hike is one of the many outsized increases that Canadian Central Bank has done this year, which is amongst the most aggressive as far as G7 economies are concerned. The rate increases come as Canadian economy continues to strengthen with solid job growth while wages are going up. Recent rate hike by Bank of Canada on 7th October is a move similar to that of US Federal Reserve very shortly. According to some experts, there is a reasonable chance Bank of Canada will hike its benchmark rate again towards the end of this year. Right now the benchmark rate is close to 4%, but keep in mind it was close to 0.5% at the start of 2022, which shows the rapid rate hike that we have seen in a relatively shorter period of time, where the aim is to clamp down on rampant inflation in the economy. Recent rate hikes this year came into play after nearly 7 years. Even though this move was widely expected, still it could have a big impact on consumers. For sure, variable rate mortgages will become more expensive, so opting for a fixed rate mortgage seems like a smart move, but lines of credit and other forms of debt tied to the prime rate will surely go up. An average Canadian owes $67 for every dollar of disposable income they have, hence leaving little room for unexpected expenses or a financial emergency. If bank rate continue to go up, the higher cost of borrowing would dampen consumer spending, which would impact our economy very negatively. A rate hike can have a big impact on any business. For small businesses, it could lead to higher cost of borrowing to finance things like inventory or expansion, which makes it harder to compete against larger businesses who may have access to larger capital. For larger businesses, it can cause uncertainty and lead to slower growth while impacting their investment and hiring plans. Ultimately, such a rate hike can have a ripple effect on the economy as a whole, which I am sure is being monitored very closely by Bank of Canada. This year, Bank of Canada has raised interest rates multiple times while analysts are predicting more hikes to come in the future. The most immediate impact of a rate hike is on variable mortgages and lines of credit, which will become more expensive immediately. This directly affects borrowing capacity that impacts how much you can afford to buy as mortgage payments become out of reach while putting strain on people's finances. The other impact being value of houses could drop, especially in markets where prices have been rising rapidly in the recent years. Surely, if rates continue to rise, it could lead to another downturn in the housing market. A rate hike in Canada would have multiple implications. The Bank of Canada's move could put pressure on the loonie, which have been trading at a multi-year low. It would likely cause Canadian dollar to strengthen relative to other major currencies, which could be good for Canadians traveling abroad, but bad for companies that export, whereas imported goods will become even more expensive. Higher rates would also make it more expensive for people to borrow money, which could lead to a slower economic growth. On the other hand, it could attract more foreign investments into Canada, which could help offset any possible slowdown in the growth. The implications of these rate hikes will be far reaching for Canadians, like higher borrowing costs for consumers as well as businesses. This will surely put pressure on already indebted households and could weigh on the economic growth. The Bank of Canada's rate hike is also expected to have an impact on stock market negatively, thus it will impact people's pensions as well. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor, so please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.